Hi, this is Mike the Ex-Loan Guy, and this is the very first video blog that I'm putting on the Ex-Loan Guy blog. Today's topic, and I'm just going to touch on it, and you can read the rest of the blog on the text version, but today's topic is I want to talk about one of the quickest ways and one of the main things that the mortgage industry can do that will create a better, more positive outcome for all involved. I'm talking about the lenders, the loan officers, the borrowers, the title companies, the appraisals, the whole 9 yards. And that is, if you were to tie compensation to the loan officer and to the originating company, all right, the lender, if you were to tie compensation to the quality of the loans and the longevity of the loans as it pertains to them paying on time and keeping those loans in good standing on the books while that loan is being serviced, much like the insurance industry does, in that insurance agents are paid residual commissions or residual payments based on how long the insurance policy stays in effect. And if the insurance policy goes bad within the first year, or if the individual allows it to lapse or to not pay the premiums, that is the customer on that in that instance, then the insurance agent has to rebate partial or all of his or her commissions or the payments that he or she has received after the contract was signed is accepted by the insurance company. What's happened in the mortgage industry in the last 15 or 20 years in the securitization market, and that is when these loans are bundled and they're put together and they're sold, the performance of those loans are sold on Wall Street. What happens is, in many cases, the loan officer and the originator don't follow and they aren't rewarded as that loan stays on the books and is paid properly for 10, 15, 20, 30 years, however long the term of the mortgage is. So what happens is you have a disconnect. You have the originators on one side and the loan officers that are putting together those loans. Their interest is getting the loan to qualify and getting the loan closed. Not that they don't care about how the loan performs down the road, but in many instances there is no incentive on whether the loan stays on the books for 10 years, 5 years, 3 years, or if the loan is refinanced. And in many cases, even if the loan were to go bad and would result in a foreclosure or a reduction in principal to the consumer, the loan officer and the originators in many of those cases are not affected. So one of the key and easy ways that could help create a situation where the loan officer and the originators, the lenders and the borrowers, their interest is all in line, is to tie compensation back to the originator and back to the individual loan officer for the quality of the loans and the longevity of those loans. So a loan officer can, in a sense, be receiving diminished residual commissions based on how long the loan stays on the books and how long the loan is paid. So a loan officer can, in a sense, get paid for 10, 15, 20, 30 years, whereas it's front-loaded. Obviously, the loan officer could make more in the beginning, and then it is a residual, it's a diminished commission over time. So that's just one idea. You may have heard this floated by a few individuals out there, but I really believe that this is the best and one of the most effective ways to revamp the mortgage origination community. So read down below. There's some interesting links on the blog. You may have fun reading that. Some of you, it may put you to sleep, so be sure to read it in bed. But I will talk to you next time on the Ex-Loan Guy video blog.